While the TSX market hasn't been doing so great since the beginning of the year compared to the S&P 500, this could represent some excellent opportunities for you to buy companies that are giving great dividend income, but most importantly, great growing dividends. In fact, when you want to purchase any kind of stock, you should not always look for the highest dividend yield, but also for how much the dividend is sustainable on the long term to make sure that the dividend payments are not going to affect the overall growth of the companies. And it is why today I'll share with you 3 of the best Canadian dividend growth stocks that are currently trading at discount. The first business on my list is the Canadian National Railway with the ticker CNR. This company that's worth close to $100 billion is Canada's largest railway company with over 30,000 kilometers of track connecting the 3 main coasts of North America, which are the Atlantic, the Pacific, and the Gulf of Mexico. Throughout the last couple of decades, they've continued to expand the territory of their railways, notably by making many great acquisitions in the US, for example, by acquiring other railroads such as the Illinois Central. And so it is just like if this company was trying to play Monopoly by acquiring multiple railroads all across North America, and it is why through the age they have become a real leader in the transportation fields of people and of goods. But not only that, CN is also one of Canada's largest trucking companies with over 1,000 operators and 8,000 containers, and so you can understand that they have a great business model in the long term, because we will continue to have some needs on their side as long as we don't have any kinds of flying trains. And as such, the railways are often considered as the bellwether of the Canadian economy. When the railway sector is struggling, it means that the Canadian economy is starting to slow, as we've been able to see over the last year, where the global economy has slowed and where this company has lost about 5% of its total value. But with a beta of less than 1, it means that this type of company won't fluctuate too much compared to the overall market. And with some great profitability metrics, this is showing to all the investors that CN could be a great long-term buying opportunity. And what is particularly interesting for every dividend income investors is their past dividend history of growth, where they've been able to grow their dividends over the last 27 years with an excellent dividend growth rate over the last 5 years of about 12% per year. And so to all the investors that are only looking at the dividend yield to evaluate the potential of these types of companies, you might find that this one isn't that attractive with only a dividend yield of about 2%. But the thing is that with a dividend payout ratio of only about 42%, it is showing that this company isn't using too much of their retained earnings to pay the dividends to their shareholders, and instead they'll use the surplus of cash that they've built through times to expand the scope of their operations to make the company grow even faster. And it is why this company, just like the 2 next picks on my list, is able to grow faster in terms of capital appreciation compared to only some high yielding dividend companies. And talking about the company that has been able to grow a lot over the last couple of years, the next pick on my list is the company Couche-Tard with the ticker ATD. This business that's worth over $75 billion is the second largest convenience stores in the world with over 7,000 retail places all around the globe. And in fact, they are not only known under the name Couche-Tard, but also Inco and most importantly, Circle K. As any great convenience stores, Couche-Tard is providing important products and services to their different customers, including great convenience products such as foods, beverage, and cigarettes, but also great mobility services such as road transportation fuel and electric vehicle chargers. In fact, one of the greatest concerns about this type of company for the future is about the transition from the gas cars to the electric vehicles. Indeed, with the upcoming switch that is coming up over the next 2 decades concerning the electric vehicles that are going to become more and more important in our economy, well, it means that these type of companies that were making the largest chunk of their revenue in the past from the sales of gas will need to adjust their business model in the future. But on their side, Couche-Tard has started this revolution years ago, where they've started to implement new electric vehicle chargers all around North America. And throughout the ages, they've continued to make many important acquisitions to expand the scope of their operations, where more recently, they've notably bought over 2,000 new gas stations from Total Energies. And when we take a look at its past performance over the last year, where it has gained over 30% of return, which is over 2 times what the market has returned since that period. Combined with some excellent revenue growth over the last 4 years, we can understand that this business isn't fully dependent on the oil price. But what is truly amazing about this business isn't only about its capital growth over time, but also about its dividend growth history. Indeed, by having an excellent dividend growth history over the last 13 years and some great dividend growth rate over the last 5 years of over 20%, and with a dividend payout ratio of only about 12% at the moment, Couche-Tard is a no-brainer for any investors looking for great dividend growth and, most importantly, capital appreciation over the next decade. And so just like CN with a low dividend yield that is less than 1%, you can still see that Couche-Tard represent a great buying opportunity for many investors on the long term. And finally, third on my list is the company Fortis with the ticker FTS. As Canada's largest utility company and in the top 25 of the largest companies of its kind in the world with a market cap of over $25 billion, Fortis could be a great alternative to the 2 other previous picks that I've just presented to you if you're looking for some slightly higher dividend payments of about 4% per year. Indeed, this company that has grown from a small $300 million of assets in 1985 at its creation to over $66 billion of assets right now, Fortis is now serving over 3.5 million customers all around North America and in the Caribbean. In 2022, Fortis has generated some revenue of over $11 billion that were mainly coming from all their different centrals, for example, the Central of Hudson, the UNS Energy, Fortis BC Energy, and Fortis Alberta. On their part, these centrals are making the largest chunk of their income throughout the sales and the production of electricity and of gas. And on your part, by investing in that type of company, you are investing in a super stable company that hasn't moved that much over the last year. And with a beta of about 0.21, you can understand that this business will tend to fluctuate way less compared to the overall market. But as for the other 2 picks on my list, this business has also been able to continuously grow their total revenue over the last 4 years, which is an excellent news for the investors. And so their business model is also as essential as the other 2 picks, because as long as we'll continue to need to warm ourselves with electricity and with gas, well, we will obviously continue to have some big needs for these type of companies. And as an investor on your side, what is particularly interesting and impressive about this business is their super great dividend growth history of over 50 years. And in fact, Fortis is actually the second company in Canada with the longest dividend growth streak, and it will be one of the first companies in Canada to reach the dividend king status, which is reserved for every company that is able to reach some dividend growth streaks of over 50 years. Over the last 5 years, we've been able to see that this business has been able to grow their dividends on average of about 6% per year. But with a dividend payout ratio of about 70%, you can understand that this business won't be able to grow their dividends in the future as fast as the 2 other previous picks on my list. But if you want to receive a great dividend yield by also receiving some great dividend growth over the next couple of years, you can be sure that this type of company is the king on that side. So there you have it. Those are 3 great Canadian dividend growth stocks that are currently at discount right now and that should be able to continue to grow their dividends in the future. Obviously, dividends are one part of the equation when you want to invest, but the other part that is also as much as important is the capital appreciation of your investment. So on your side, if you're looking for great alternatives to grow your capital as much as possible in the long term, well, check out the video that's gonna be right over here and I will see you soon. Peace!